Hello, hello. Welcome to the Trading Zone. I am Joe Teagay, and with me is Brian Stutland. How's it going, Brian?
Joe, how you doing? Great. Brian Stutland here, portfolio manager at Equity Armor Investments. We are bringing right at you live the Trading Zone here every Monday, 1 p.m. Eastern Time. A little bit of a late start here, just a couple of minutes, technical difficulties, but we're going to bring it to you. We have a great show today. Lots to talk about. Big, huge week for the markets. To quote the Donald Trump and the debates from last week. Huge
Huge.
week this week with Federal Reserve meeting.
A lot of price action, the greatest price action in the history. It's going to be a great show. It seems like every week, Brian, it's like this is the biggest week for markets. What are you going to expect? You get Nvidia earnings, that was huge. Last week with the PPI, CPI, that was really important. Now we got the Fed, and I was expecting, Brian, last week that the decision would have been decided on that PPI. Like we would have known, is it 25 or is it 50? We knew there was going to be a cut, but we don't really know sitting here right now. It's still 60-40, 60% of the market says a 50 basis point cut, 40 says a 25 basis point cut. And yeah, that is really fascinating to me.
Yeah, well, our big story, so hopefully everybody tunes in. We're waiting for more people to sort of join here, and we'll get right into it. But later on, our big story really is talking about what's the playbook if what the Fed does is 50 basis points, or what happens if it's 25 basis points? Because, Joe, you mentioned everybody's expectations is right in the middle of 38. It seems like they should just, cut rates by 37.5 basis points.
That's a great point. There's nothing that says that they can't. I think the Fed just does it at 25-point increments just because it's kind of easier and everyone gets cleaner and people understand that. But there's nothing saying that they can't cut it by anything in between. And I don't know why they don't. Maybe in the future we'll see that, like more constant, smaller cuts, a little more fluid movement in the overnight bank lending rate, than rather than just stuck it at one level forever. So yeah, that is for me. Yeah, if we're in between, why not just cut in between? Why not go 1.5 cuts or 37.5 basis points?
Yeah. Well, so because of that, because they're going to go a quarter one way or the other, or 50 basis points. We're going to lay out a playbook on what we think if they go 50, what we think the markets will do if they go 25, how the markets might pivot and look at it differently, and what we think there will be some movement. And on top of that, we do have a trade at the end of the show. We've never actually given a trade on this. It's a major index, and it's trading at all-time highs. So we want to talk about what we do with that.
Maybe you guys have heard of it. I don't know. We'll see. Yes, welcome back to the Trading Zone again. Thanks everybody for joining in. It's great to have you here every Monday, 1 Eastern. I'm Joe Teagay. This is Brian Stutland with me. We're former options market makers on the SIBO. We cut our teeth in the VIX pit. Brian was one of the early adapters to trading VIX options and futures right when it started in 2007. So we have a wealth of knowledge when it comes to volatility trading, and certainly a specialty when it comes to volatility futures and options trading. And we will, try to bring that wisdom as best we can to you. Hopefully you guys get something from watching us every week. So like we're talking about, big week, FOMC meeting, what will they do? And, the market's kind of poised here for a big move just because of the uncertainty. They're not really sure. Is it going to be a small 25 basis point cut or a medium 50 basis point cut?
Yeah, and where they go from here is going to probably move the market pretty largely. When I was looking at options that trade to kind of give an indication of expectations, basically the market was looking for a 1.5% move or so by the end of this week, by the end of Friday. So there's going to be quite some movement here with the VIX now trading in the upper teens. That also represents a historical or implied move of just over 1% most of the time. So with a 5% chance that we get a 2% move. So certainly there's going to be some movement off these levels, and we want to cover that and go over some trading levels that we're looking to trade in and out of.
Yeah, but we have the spike index and the VIX index now trading under 18. Of course, it was higher last week. We were expecting a bigger move on the CPI and PPI week. So it is interesting to see that coming in spite of the fact there's still the uncertainty with this event. Key events on the week. Yeah, we got the Fed policy rate decision. That is the most important one for me. Now, remember, we brought this up last week. This is crucial to remember, Brian. Everything seems copacetic right now, but the market usually tends to trade lower when the Fed is cutting rates. The Fed's cutting rates when the economy is slowing down. Is that actually happening now? Remains to be seen for sure. Although, I think before most of these other recessions, we could have said, hey, the soft landing looks like the base case here. Is that what we're looking at today? We'll see maybe a lot more in 2 quarters.
Well, those are some scary returns for sure, Joe. Really 1980 really being the only positive performer, really, and all the others really going negative. So, but I do think, and we'll cover this in a little bit, I do think some of the technicals are lining up rather bullish. We did have a washout in volatility. The VIX temporarily, pre-market at the open was trading over 60. It probably blew some people out of the market. Big carpet shakeout in August. And we kind of got then here in September, retracement off the lows back to the high recently, and then came back down with a 50% retracement. So there are some technicals that line up really well, and we'll get more detailed into that in the show as the show goes on.
Yeah, we're getting some comments rolling in here. Thanks a lot to Kyle. Happy Monday. Looking forward to the show too. We're still got a lot to go here. As before we get into the volatility zone here, we're going to talk about some volatility trading. Let me point this out. How can you plan to adjust strategies if you predicted differently than what it happens? If you expect 25 basis points and the cut is actually 50, or vice versa. I think the devil is going to be in the details, and we'll get into that in a little bit. Basically, long story short, if they happen to cut 25, I think it will be a dovish 25 basis point cut. They'll talk about how ready they are to cut more in the future and how much more cuts they have coming. If they happen to cut 50, I think the reverse will be true. They're saying, hey, we're getting out in front of this. We're cutting early, but because we're cutting early, we'll have fewer cuts in the future. So I think we'll be somewhere in between there. I think again, it really depends on what they say, and it'll come back to if the economy is coming into a recession. If the economy is coming into a recession, this is the chart we have to look forward to. If the economy is not in a recession, and maybe what's different now, which the reason why it could avoid a recession is the record deficit spending the government's putting out there right now, the COVID era spending, which just has not stopped. Maybe that's why we can avoid a recession. Maybe that's a problem for inflation in a couple of years, but next year should be fine. And I guess that's all that matters for everyone is right in front of our nose. So that's for me what we're watching here. Brian, you got any thoughts on that?
Yeah, well, I think, maybe this is a good moment actually to sort of just transition and talk about the volatility landscape itself.
That's the next question.
Oh, look at that.
Let's look at that. Go ahead.
Yeah, let's actually, that's a good question. Let's get into that. That will maybe kind of dictate how I would be looking at what I expect from the Fed and where I think the markets are going to go. When you look at that skew in the 1 year, now remember, this is a chart that depicts how expensive an out of the money put is versus an out of the money call. A put being protection to the downside or the right to short the market. A call being an option contract that gives you the right to buy into the market at a level, no matter how high it goes. So we always like to watch how are those two behaving on a relative basis to each other. And you can see here, we had a lot of scare and panic, and it already had started going up where there was this massive put buying going on just before the August sell-off. And now that demand for the put hasn't been there like we've seen before. So I think this is a somewhat positive sign, but it's still, if you're a trend trader, it's still, higher lows are occurring. We'd love to see some sort of shift where, call buyers really want this market, and that kind of runs people over.
Yeah, I think we just need to adjust our whole volatility regime higher. Remember last week we're talking about the yield curve was steepening. That means volatility is going to be in a higher regime. Yeah, that's what we're seeing here. We were in this lower regime here. for the past year and a half. This is now essentially becoming a floor here. This resistance is now kind of becoming a floor. So this is just kind of on the lower end of the range. I think that's okay. We just have a new baseline of where this level is. So we're just kind of at the lower end of the range. Again, usually, volatility is mean reverting. That might mean volatility will be ticking up over the next couple of weeks if that happens to be true.
Yeah. So let's look at what else we got. Futures, VIX futures curve here. Taking a look at this here. Again, we're not as high as we were a week ago. We're also not as low.
This was last week. This is us today.
Yeah, and we're not as low as we were 2 months ago. So we have kind of mean reverted in between the two. That's what volatility does, right? It gets stretched so far in one direction and then kind of snaps back. So I do think we're in this. This is the one thing that makes me nervous about the market. I think a lot of other technicals on price action of the S&P 500 itself are positive, bullishness to the upside. This is the one where it could go in either direction, I think, and scares me a little bit because the rubber band got stretched, it snapped back, and now it's sitting in the middle somewhere, and it's really on, straddling for, lack of a better word, pun intended, in option trading, straddling to go one way or the other.
Yeah, and the one thing I want to point out on this chart, Brian, is so last week this is the front month. This is where the cash is. The front month future traders were expecting the cash to come lower following the CPI PPI last week. This week, the front month is September. The September is expiring on Wednesday morning before the Fed policy decision. So they're expecting volatility to come lower into the policy decision. Now, that's actually what usually happens for these futures. They usually do go lower, especially when you have the VIX in this area, in this 1817 area. You expect them to go lower, but it's surprising the futures traders are expecting it to come lower prior to the meeting. Usually, from my experience, volatility stays bid into these events. We'll see what happens, but I think, the more important future right now, just because this is expiring before the meeting, not a lot happening before the meeting. The more important future right now is this October future. And volatility traders are expecting big moves, through October surprises perhaps. And of course, that future represents the November S&P options, which of course carries with it the election.
Yeah.
So that's the futures. I find that fascinating. Let's take a look at this S&P trends. We've been following this all year long. Of course, we broke this, accelerated trend line, but we're still above this, slower trend line. So there's no question we're still bullish. We've just kind of lost some of the upward momentum. Maybe that's okay. We don't need to explode up 1% every single day. Just grinding higher might be a little healthier rallier anyways.
Traders talk about triple tops, but Joe, I mean, how often is a triple top really happen?
Is there even such a thing? Let's see. 1, 2, is this 3? I don't know. I think usually this looks more like, we got some resistance right here. And the more times resistance is tested, it's more likely to break. That might be what I'm seeing here. Yeah. And for the double bottoms, Brian, I think you want to see, you get this lower low here and then a lower high. That's kind of what a double bottom is. If it were to be a triple top, wouldn't this have had to come down here?
Yeah.
A lower low. Yeah.
Yeah. I think the trend would be shifting with lower lows, lower highs. Then all of a sudden it breaks down and falls apart. Not kind of cone consolidate there. And then typically, like you said, the more times that resistance is tested, the more likely it is then to eventually just bust right through. So that's why I was saying earlier, I think the technicals to the S&P 500 are to the upside. Notwithstanding there is some risk, right? I still want to see unemployment rates on a fundamental basis stabilize, come lower, not tick up when we get to October, not tick up when we get to November. So I want to see that stabilize. I want to see the Federal Reserve providing us enough liquidity coming up. So there are other fundamental circumstances to look at this, but this would be the one chart that maybe is a little concerning where, if the SMH and the semiconductors sort of falter here and go back and retest that red lower level, I would start to get concerned.
it's still so uncertain. Today is another, rotation or risk off day when it comes to the semis. It's kind of having the opposite of what we saw last week for certain, but it's just really in no man's land still. It was able to hold on to this trend line last week, had a really good, healthy bounce for me off of this trend line last week, but now kind of stalling out. I don't know if the S&P rally is sustainable if it's not coming with the semis here. If the semis aren't looking a lot healthier, a lot stronger. Now, they don't have to be leading. The semis don't have to be, making all-time highs or up 3% every day, but they do. The chart has to be trending higher, has to be making some higher highs here for me, for the S&P rally to look a lot more credible.
Well, let me ask you this something, Joe, because I was looking at the S&P 100, right? The top 100 S&P stocks. Like back when I was trading on the floor a long time ago, the main pit was called the OEX, which was the S&P 100 options pit. That's where everything traded. That was where the big volume traded on the trading floors. In the S&P 100, NVIDIA is a big component of that. I think it sits at about a 9% weight. Do you think SMH is broken to some degree in the sense that the rest of the semis, it's just NVIDIA or, NVIDIA and a handful of other names or bust, and everybody else is meaningless. And so now all these other names that are meaningless are bringing down the sector as a whole. And this might just be representative of a rotation out of the junk semiconductors into the future of semiconducting.
Yes, Intel carried a huge weight, but Intel, of course, has just been so terrible. But I don't think that matters so much because Intel is so big and in so many products. I think if the economy is growing, if people are being hired at work, companies will be buying computers, companies will be buying tablets, etc. NVIDIA will be benefiting if that were to ever happen. So yes, I think it does matter. It is a sign, and it is a leading indicator for me. And I think it's even better that there are other components in it that are not having the NVIDIA type gains. So I don't have a problem with NVIDIA being the lion's share of the gains, and I think it's still a valid index.
Yeah. And so, I mean, for me, if I was going to play more of a semiconductor play, I like I mentioned, S&P 100 probably is more representative of that as well, because NVIDIA is such a big weight in there. Or you could look at some other technology sector type names that we also own for clients too. So, yeah, but I mean, I think some of these charts kind of get to the point where we're on the fence of which way volatility could go, the VIX futures. We're on the fence on which way semiconductors can go, and can they be the market leaders? So I think it really comes down to the playbook, what the Fed is going to do. We probably should just get into that, whether they cut 50 basis points or not. Let's first talk about the back end, because last week we talked about the 30-year Treasury. Let's talk about rates on the back end, and we'll kind of work our way up into the playbook of the front end of the interest rate curve. I think that makes sense.
Yeah, just bottom line, our trade last week, we were looking at initiating a trade for clients looking at bonds. We did so by selling a put. It's kind of a way to add a little bit of yield to everything and take a long position in the back end of the curve.
Yeah, we made shifts for client portfolios where we moved out of the front end of the curve into the back end of the curve, interest rate curve, meaning going longer duration, because we think there's maybe some value to be had there. We'll get into it, but if you look at like the Fed fund dot longer term out there, it looks like the trend is for the back end of the curve to go lower in interest rates. Yeah, there we go. Here's a Fed dot plot right here. Look at that last item all the way on the end, the longer term, and where the Fed. Now we'll get a good new look on Wednesday because they'll sort of
right
re-estimate
every quarter we're going to get a new dot plot. This will be, the September meeting is when we're going to get our new dot plot. The next one will come in December. So we'll get the update on the Fed. So this is going to be moving the back end.
Yeah, and if the average dot plot in the back end is below 3%, then it probably means the 10-year or mortgage rates need to go lower. And so that's why we kind of had shifted out of the short end of the term. And so far it's paid off for us. And I think it will continue to provide a pretty good hedge to the stock market as long as you're matched up pretty well between stocks and bonds in that sense.
Yeah, and for sure. And like we were talking about up at the beginning, so we got the Fed. They're going to do one of two things. We know. We know for sure that's going to be a cut. It's going to be 25 or it's going to be 50. The question then happens, okay, now where do they put these dot plots? And I think this is like sneaky, really influential on the market, right? Because we're talking about if they cut 25, they can also influence it by being very dovish by saying, hey, these are going to be lower than we currently have said. So that's kind of the same thing as cutting 50 without
Right.
actually technically cutting 50. Or if they cut 50, they can shift these higher or and say, hey, we're not going to cut as many times as we previously said. So my expectation is that they'll, give us one thing and take away another part, or vice versa, just to kind of level those expectations out.
Yeah, definitely. And Joe, you mentioned before we did a trade on TLT. We sold a put. Just a shameless plug here. Pretty exciting coming up. Release in 2 weeks. We're going to have a new sort of option, call it, pun intended again, for investors actually to receive our trade alerts directly to their inbox. There's some special offers as well that we'll have where if people open up a Tradier account, for example, they'll get 8 months free to our trade alert ideas. So we're really excited about this offering. So as we speak about these trades on the weekdays, boom, you can have it sent right to your inbox. If you have a Tradier account, it even can help populate a trade ticket for you. So that's going to be really exciting for us to offer, along with a couple other strategies like our investing in the AI world of generative AI, because we talk about that a lot here on this show. So people would be able to follow along with those trades as well. We did a fantastic job actually last week scooping up calls on a lot of these names that I already have had to like roll those calls to a higher strike value because it's already like blown through the value of those. So there'll be some access to that. So come check us out on equityarmorinvestments.com. 2 weeks we'll be rolling it out. You'll see a whole new sort of web page and offering. And, I obviously recommend coming and checking it out and being a part of that. We'd love to have you join our subscription model.
Yeah, that is super exciting. I can't wait for that. Remember, you can also right now, either by messaging me right now, you can ask for it, or you can go online, just look at go to equityarmorinvestments.com, and you can check out our free our trade options trading book. Just a fantastic book about Brian's time on the floor, some comments and commentary of my days on the floor and Luke Rabari's days on the trading floor. So I think it's a really good book. You can either ask for it now, right now, you can put a message in the chat, or you can check it out on our website. You can pick up your free copy there too. So back to the Fed policy decision. I actually kind of think there's a bullish case, there's a bearish case for these scenarios. I kind of think the Fed's going to want to make it seem bullish, just because that's what they do. So I kind of think a 50 basis point cut, they can make it come off as bullish as if they just say, hey, the economy is great, inflation is great. We just want to get ahead of the game. Nothing to worry about. There's no slowing down. We just want to get ahead of the game so that there is no slowdown. I think that's one possibility. Or 25 basis point cut. They can say, hey, we don't need to cut 50 because the economy is so strong. We'll cut again. We'll cut strong if the economy does slow down. But until then, we're happy with the economy and everything is great. And by the way, inflation is not a problem. I think a bear case could be a 50 basis point cut, and they say, oh, we are aggressive. We're gonna get this economy rolling because the economy is slowing down. Or a 25 basis point cut, and they say, we wish we could cut more, but inflation is too high. Again, I think the two bullish cases are a little more likely.
Oh yeah, I mean they almost always try and paint a rosy picture on what they're doing. Here's my feeling though: if they go 50, actually, I think the market will like that. I think they'll be like, okay, you know what? These guys are trying to get way ahead of the curve. They're trying to provide the liquidity necessary. They're trying to drive down volatility in the stock market by cutting more than what the market's expecting, right? Because they're expecting 38, so 50 would be more than what the market is expecting. And that sort of scenario might drive a 1998 situation with, technology boom, the Fed cutting more than people expected. And I think that the market will welcome that. I think if they go
Again, yeah, but it's critical that they are not signaling, hey, we're cutting because this economy is so bad. They're just kind of saying, hey, we're cutting preactively ahead of the curve. We're cutting. I think the market will like that.
yeah. And then I think they'll paint a rosy picture about a 25 basis point cut, but I don't know if the market will really like that. I don't think the market liked the fact they didn't do anything in July. So I think the same sort of reaction will happen again. I don't think the market will like that they're cutting rates less than what the market expects. And I think the stock market will punish them a little bit for that decision.
Yep.
Now,
Not
I would
if they say, hey, believe me, this economy is strong. We don't need to. This is the right cut. I think the market might have a vote of confidence there.
Yeah, I don't know. It might create a little bit of a temporary scare to me, Joe. I mean, I think you
The
look at
only thing that's going to scare me is a slow economy. That for me, like job losses, GDP. That's when these companies are going to start, not putting up their numbers. That's I need a strong economy for this to work. And if the Fed is signaling, hey, this economy is strong, I like it for the stock market.
Well, I think that's a great point, really, because yes, the playbook might be 25 basis point cut only, and it kind of freaks people out a little bit. Maybe you get a little temporary sell off, but that might be an opportunity to buy because it really comes down to now. Let's look at how
And
things are on the
yeah,
unemployment
that
report
might,
come
and that
October.
also might lead more towards the tech, the semiconductors, a lot of these mega cap tech stocks that don't have debt. Doesn't really matter what the Fed's doing, but if the economy is strong, it's better for them.
Correct. So, it still will be data dependent, earnings driven. October will be a big month for the market. And we just might get that temporary, 1-2% kind of move, shake out back and forth in the market. And then it'll come down to data going forward on the economy. And if it can kind of hold up and if the Fed does what they think their cuts can do to orchestrate a soft landing, people might freak out about the 25 basis point cut initially, would be my initial expectation. But then it
So
does come down
if
to,
you had to guess, put you on the spot, what's the Fed going to do, 50 or 25?
man, I mean, Powell he's never really moved greater than, a surprise move, right? He's really been very transparent. So to me, that says they'll do just 25.
Because they've
Um,
only said 25 in the past.
yeah. Yeah. I
Well,
mean,
that's a good point. I kind of think I'm kind of leaning toward. I was 25 all of last week, but until this weekend, I think the market was pricing in 25, and then just something shifted. There's like, hey, I think the Fed can do 50. And now we're at the favorite being 50. I think the Powell's going to go with the favorite. I think the favorite's going to be right. 60-40 for 50. I'm leaning 50, and I think our trade of the week is going to perform quite well if it does happen to be 50. So, what do you agree with that?
yeah, I do. And so let's talk about that actually, Joe. This is an index you may know about. It's called the Dow
Might have
Jones
heard it
Industrial
before.
Average. The Dow Jones Industrial Average. DIA is an ETF that tracks the Dow Jones Industrial Average. So it's something that allows investors to actually invest in without having to buy the 30 names in there. And look at that. This is an index trading at all-time highs. To me, this is a index that tells me the health of the economy to some degree. And the insight here is that things are very good and very rosy. We've seen a couple trends here, these couple trend channels that have occurred. Joe, how would you be playing this given, we're back at the top end of a trend channel that occurred? Is this breakout or breakdown?
Yeah, well, this is a precarious spot. This is 100% a spot that we're going to be seeing some volatility for me. So we're at the high end of the range. I could very easily see this turning around and going back down here. There's no question about that. But if the market does really, really like what the Fed has to say tomorrow, if the Fed gives us Christmas in September, we might see a breakout. And I kind of like the chances here. And the way that I want to play it, because again, we've talked about earlier in the show how volatility has found a higher baseline. We're going to have a higher floor for volatility for this period of time. I want to own calls to express my long position in the market for the next 6 months.
Yeah, and I think, we talked earlier in the show about the skew in the S&P 500, and the Dow, is related. They're somewhat correlated to each other. But the skew being still somewhat steep with higher lows relative to where it was in a few weeks or a couple months ago, I guess I should say, does make it a little bit cheaper to own a call than normal. Or than we were even like just a few weeks ago.
So yeah, and also I'm hopeful for something like this happening. Where we went from 360 to about 390 in a month and a half.
Right. And so you get a breakout again, it does something like that to the upside and forms a new higher level channel. Yeah, that's right. I mean, I would want to also own a call to play that breakout to the upside, but not have any more risk in case, we go back down to the lower channel or even worse, break the lower channel.
Right. It's very easy to see us back down here testing this at about, 385. Very easy to see that happening given where the price is at 416. So to see, $30+ to downside could be very painful. So yeah, it makes a lot of sense to own a call, and I want to own it for some duration here. I want to give this some time. So I'm looking out through March of 2025. Looking just close to the at the money, a little bit out of the money, 420 call. I can own that for $17, about 4%. Cost me about 4% down to own NVIDIA. But again, that's most I can lose. We talked about potential downside risk is upwards of 10+% over that period. So I like that risk reward. And I'm looking for some upward volatility, upward movement. And should we get that nice move like we saw back this summer, last September. Hopefully we do it. Hopefully that happens again. Get the Christmas rally. I'd love to take some of this volatility off by selling a call and turning this call into a call spread.
Yeah, and if you look at the gap between the last two trend line areas of breakout, that was call it a little over 40-point move. So $17, very easy to make that up, the cost of the premium or the call. And then couple that with the fact that the lower end of the channel alone could be a 17-point move down. And there still would be value in those calls, remember, because this is a March expiration. So I like that going a little bit further out on the time to expire, because if we're wrong about buying the call, Joe, if you're wrong about that, there still would be some value left in the calls, and that would probably be a lot better value play than just riding the market down in a 100% long position in the stock.
Yeah, well, thank you very much for that. Although it was a collaborative effort, of course, we both came up with this together. So obviously, we like our trade, and this is kind of how we're lining ourselves up for a lot of other trades. Just using calls, using the volatility to our advantage right now, because there's a lot of movement happening right now, and we're just at the part of the cycle we talked about last week. The Fed starts to lower rates, the yield curve starts to get steeper. We see volatility on the rise. Already seen that happening a little bit. I think we're at the new baseline, the new lower range for volatility. So I'm happy to pick some up right here.
Yeah. So yeah, I mean, again, I want to just promote really exciting. Come roughly around October 1st. Come check out our website. We'll have it new revamped. Not only, I mean, we continue to still manage money for individual clients through Equity Armor Investments, but we also will be offering these Trade Alert subscriptions for people. So it's kind of exciting, and still doing, working with institutions to other investment advisors to help them out with our outsourced CIO programs and whatnot. So really exciting to come check out and see what fits you as an investor. Hopefully we cover it all, and then you can follow along with a lot of these trades much easier than just having to tune in right here and then pull the trigger. You'll get that alert sent right to you, and you'll be able to pull the trigger and trade it from there.
Shout out to Kyle. He enjoyed the back and forth commentary today. So did I. Thank you, Kyle, for checking us out. Second comment of the day. That is really, really awesome. Really appreciate your support. There's 156 other people here. How come Kyle's the only person saying hi? Where's everyone else saying hi? Come on, people. I need some more love.
Yeah, they're shy. They're listening. They're paying attention. But
hopefully
anyways,
hopefully what we're doing is useful. I really enjoy coming on every week and trying to express some of the knowledge I picked up over the years.
Yep. All right. Well, this has been a great show. Make sure you tune in every Monday, 1 p.m. Eastern, to the Trading Zone, sponsored by the MyX. We want to thank you for that sponsorship. Tradier Hub for putting this on. Tune into their channels. Great content there. And then come back here every week, every Monday. We'll see you. This is Brian Stutland, Equity Armor Investments.
And I'm Joe Teague. Have a great week.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.